Now, it was another torrid session on the stock market yesterday for some of America's regional and mid-tier banks. Los Angeles-based PacWest Bancorp fell by 51% and Phoenix-based Western Alliance Bancorp by 31%. Other major fallers included Salt Lake City-based Zion Bancorp and Dallas-based Comerica Bank, both of which fell by 12%. Well, all this follows, of course, the rescues in recent weeks of three other lenders, Signature Bank, Silicon Valley Bank and First Republic, none of which appear to have calmed nerves. Well, joining me now is Martin Ruchenwald. He's a partner at the global management consultancy Arthur D. Little. Martin, good to see you this morning. We've had three rescues where depositors lost no money. It clearly hasn't been enough to calm nerves.
Good morning, Ian. Yes, absolutely. So I think if we look at the depositor side, things have been pretty stable, actually. And interestingly, none of the depositor lost money, which is a bit surprising. Retail, yes, we understand why. Corporate, yes, we understand why, the discussion about payrolls, being paid and so on. But institutional banks, lenders, other banks depositing money with banks have also not lost money. And I think that's the big surprise, which should calm the depositor side.
So why are people yanking their money out when ostensibly they have little to fear?
I think it is just the general fear, and it's so easy nowadays, right? With a clip of a finger, you just, change banks. It's mobile banking just has changed so much nowadays. So people say, why risk it? Just go to a safer place. The question is it really a safer place?
I guess you could say it's rational in some ways, given that the three that were rescued, Signature, Silicon Valley and First Republic, they had deposits of assets of $535 billion at the beginning of the year. I mean, this has been an extraordinary turn of events.
It is, absolutely. And what I think is very interesting is that, the first one to basically come into problems had very specific reasons why, right? If you do tech, and tech is basically getting a blow and receiving a blow, well, the banks also gets a blow. I mean, banks are a reflection of the economy, effectively. Same, with a Signature Bank. If crypto is going through difficult times, well, then it's clear that the bank also goes through a difficult time if they are so related. But what we see now is that this is spreading out to banks that are, typical, I would say, universal banks. Yeah. What does this mean? We have 4,000 of those small and medium-sized banks in the US.
The FDIC, the US government agency, protects the first $250,000 worth of deposits. Would it calm things if that limit were raised?
Well, it's a big discussion, obviously, and I think, what the various crises that we've seen basically show is they do it. Yeah, they do it anyway. They come in at the end of the day to protect, depositors. The question is, what's the right level, and should it be for free? Yeah, who should pay for that?
Well, quite, yeah. I mean, one analyst yesterday was talking about there being a sort of a negative feedback loop, these share price declines potentially feeding into more deposits being taken out, which in turn feeds further share price declines. I mean, there's something in that, isn't there?
Absolutely, absolutely. I think, also when we look at the share price, I think the share price story is only the tip of the iceberg, really. I mean, not all the banks are listed. So, what's going on with the other non-listed banks? So I think a story that nobody's looking at currently is the impact on the bonds. And the bonds really make the big difference because this is where the refinancing comes from. So if cost of refinancing goes up meaningfully, the margin of the bank is basically, hit.
Absolutely. I mean, would it help if banks didn't have to mark to market the value of a lot of their assets as frequently as they do?
I think it's also quite a discussion that's an evergreen, if you want. So I think, generally speaking, transparency is a good thing. We saw this in many places, also with, Europe and in the US, going through stress tests and making sure the marks are where they're supposed to be. But then there are very special events, like, we were seeing with effectively, the bonds that they invested in, right? I mean, this is a mark-to-market loss. It's not a realized loss. Yes. You still get back 100. Yes, there is an impact over time, because of the interest rate now going up. We all understand that, but that can be spread out over years, effectively. Yeah,
exactly.
So yeah. I think it is not such a burning issue now.
The other key assets that these banks hold, of course, is their customer loans. I mean, is the deterioration of the loan book in many cases enough to justify what we're seeing?
Well, actually, currently, we still don't see a major pickup of NPLs. I think, there is cost of risk is going up, yes, but we're also coming from an ultra-low, ultra-long period of extremely low cost of risk and NPLs. So I think to a certain extent, we're going a bit back to normal.
Yeah, but so where does this all end?
I think, it's interesting to compare probably also the US, Europe. Yeah, I think, you see a lot of turmoil in the US, extremely stable situation effectively in Europe still. Yeah, so it probably also means, that Europe has done a pretty good job in, regulations and putting all these things in place, stress tests and so on, being much more rigid. But still, the banking system has a lot to do because profitability is a big issue. Most business models hasn't been changed, hasn't been really properly changed. There was cosmetics, but most banks do today what they did 10 years ago.
Yeah, Martin, one more thought for you. Obviously, JP Morgan bought the majority of First Republic last weekend. Presumably, at some point, the likes of Citi, Bank of America, Wells Fargo, if we see more collapses, they're going to have to get involved. I mean, the system can't all just it can't be left to JP Morgan, can it?
No, absolutely. So I think there's a big value in having small and regional banks. Because they, are closer to their clients, and banking to a certain extent is local. You got to be close to your clients.
All right, Martin, we've got to leave it there. Good to see you this morning. Thank you.
Thank you for having me.